Welcome back to Investing Talk Podcast. Today we're tackling a question many of you out there might be wrestling with. Is Iveda Solutions, a company making some serious noise in the smart city and AI surveillance arena, actually a good time to buy now? We've gathered, all the latest information, the facts, the forecasts to help you cut through the noise and truly understand what's unfolding with Iveda Solutions. Before we really dig into this, if you're finding these discussions valuable, and we really hope you are, please do take a moment to subscribe, hit that like button, maybe leave a comment below. We absolutely love hearing your thoughts and what companies you'd like us to look into next. And if you're feeling extra supportive, considering buying us a coffee really helps us keep bringing you these kinds of analyses. Okay, so let's unpack Iveda Solutions. At its core, this company is focused on AI-driven video surveillance and IoT platforms. Think smart cities, commercial clients. It's like providing the intelligent eyes and ears, the whole Internet of Things thing, right? Connecting devices to the network to monitor, manage, and secure these huge networks. Urban centers, individual facilities. It sounds pretty futuristic.
It really does. And what's particularly compelling, I think, is how they're positioning themselves. They're targeting these high-growth areas like smart cities, facility management. I mean, these are sectors practically begging for AI and IoT integration.
Right.
But as we start peeling back the layers, their current scale, their recent revenue trends, well, they tell a story of a company still battling, still trying to carve out significant market share against some much larger, more established competitors.
Okay, let's wind back the clock a bit. Let's see what the last 3 months, June, July, August 2025, have brought for Iveda Solutions. It's really been a mixed bag of news.
Yeah.
In August, they reported their Q2 earnings, and we saw discussions around negative price performance, continued losses, which points to some real challenges in actually monetizing their AI solutions effectively. Yet, almost in the same breath, they announced the rollout of their Iveda AI platform at Waymark Gardens.
So that's just real-world adoption, right, in multi-residential sectors?
Yeah, actual use cases. But the market, despite this adoption, kind of closed flat at $1.49, and it reflected a fear index of 39. What's your take on that, given those conflicting signals?
That's a really crucial point. And it makes you wonder, doesn't it, why, despite these clear signs of product adoption, is the market still punishing them? Negative price performance, persistent losses. It really highlights that classic hurdle for innovative tech companies, turning groundbreaking tech into consistent, scalable profitability. It's tough.
Yes, it is.
The bearish technical outlook and that fear index, they aren't just numbers. They underscore the market's skepticism. Investors are looking past the headlines, past the new adoptions, and they're demanding tangible financial execution. It's a tough environment for a company still finding its financial footing.
Absolutely. Then in July, we saw something promising. Iveda Solutions secured an initial $180,000 deal for its AI video analytics in Manila, Philippines. And that's actually part of a much larger, like $3 million multi-year smart city project. They also filed a patent for a liquid storage IoT sensor, kind of specific, and highlighted recurring revenue from licensing deals.
Okay, see, those are definitely green shoots. That Manila contract, that's a critical strategic move, pushing them into the rapidly expanding Southeast Asian market. That could be a significant growth engine beyond their traditional core,
Right, potential there.
And the patent signals a push into industrial IoT, potentially opening up entirely new vertical markets, maybe new revenue streams. And that mention of recurring revenue from licensing, that's key. That suggests they're working towards a more stable, recurring, SaaS-like business model, moving away from just one-time sales. These aren't just positive signals, they're foundational shifts that, if executed well, could be really transformative.
And rounding out that last quarter, back in June, they announced a new resort, and casinos selected their AI-powered video solutions, and they expanded their Level Now W system within Gulf Western's distribution network. You'd think that'd be great news, right? But despite these wins, shares actually declined nearly 3% that month, reflecting broader sector-wide volatility, I suppose.
It's a classic example, isn't it? Good operational news just gets overshadowed.
Yeah.
Even as they penetrate new markets like hospitality, expand their reach in industrial IoT through established distribution networks, which are, solid indicators of product market fit, the stock's performance often dances to a different tune. It tells us investors aren't just reacting to press releases anymore. They're looking for those consistent, measurable financial results, the ones that translate into sustained profitability and growth, especially in a volatile sector like this.
So with all these operational updates, the real acid test is always the financials, isn't it?
Now, how does this stuff translate onto their balance sheet, their income statement? For fiscal year 2024, Iveda Solutions reported revenue of $6.02 million, which was actually a 7.32% decline year-on-year.
To decline.
Yeah. While net losses did narrow slightly to minus $3.98 million in improvement, yes, but still a loss. The trailing 12 months revenue is $7.14 million, with a net loss of minus $3.45 million. But here's where it gets truly eye-popping. Future earnings projections for 2025 are notably bullish, like forecasts as high as $27.3 million in revenue. That implies over 340% growth. That's a staggering jump, isn't it?
It is absolutely staggering, and that's precisely where the rubber meets the road, right?
Yeah.
We're looking at this significant discrepancy between past performance and a revenue decline in 2024, consistent losses, and these truly ambitious future projections. The company isn't profitable. Negative earnings per share of minus $1.33. Predictably, no dividend payments. Their market cap is quite modest, $4.71 million. To achieve that, projected $27.3 million in 2025. Wow. That requires absolutely flawless execution, a monumental scaling effort, and probably a dash of luck, given their recent track record.
Yeah, you'd think.
And without more transparency on their debt and liquidity, that persistent net income loss just screams ongoing financing challenges. They're like predicting you'll win the lottery next year. Sure, it's possible, but yeah, flawless execution needed. Maybe some magic.
Given those numbers, let's talk valuation. Iveda Solutions' PE ratio isn't even applicable, which is usually a red flag, right?
Yeah.
Because of those negative earnings.
Right. Can't calculate it.
But its price to sales, the PS ratio, is approximately 0.66, which is remarkably low, especially when you consider the industry average typically ranges from, 2 to 5 for tech and AI sectors.
Yeah, easily.
For a high-growth tech company, isn't a low PS sometimes seen as like an overlooked opportunity, a hidden gem?
That's a great devil's advocate point. And in some cases, yes, a low PS can signal undervaluation. But for Iveda Solutions, with its sustained losses, that revenue decline, that 0.66 PS ratio isn't just low. In this high-growth sector, it's practically screaming value trap to me. It suggests the market isn't just skeptical. It's baking in either a high probability of massive dilution to keep the lights on,
Ouch.
or just a fundamental disbelief in their ability to ever turn those ambitious projections into actual profits, despite the compelling technology,
Right.
Traditional valuation models like discounted cash flow, they're frankly unreliable here. Negative cash flows, immense uncertainty in future revenue growth. The market is pricing in significant risks, not just a bargain.
Okay, here's where things get really interesting for the near future, though. We've got a few key dates on the calendar. Could shake things up. September 29th, there's a technical forecast cross, target $1.66. Then October 10th brings ETF sector rebalancing for AI and IoT, always a potential catalyst.
Always volatile, yeah.
After that, we'll see a facility manager's holiday procurement report on November 4th. Could give us a real-world pulse. November 15th is the deadline for institutional position filings. And then, the big one, December 2nd is their Q3 2025 earnings release. Which of these are you watching most closely?
That's a fantastic lineup of potential catalysts, each with its own flavor of volatility for me. The Q3 earnings release on December 2nd, that's going to be under immense scrutiny.
Yeah, I think.
Oh, yeah. The market will be dissecting it, looking for any signs of recurring revenue growth, concrete adoption in those new markets like Southeast Asia, and critically, progress on margin improvement. Are they turning those contracts into actual cash?
Right, the follow-through.
Exactly. The ETF sector rebalancing in October could drive some abnormal volume price swings, just as institutional funds adjust their AI and IoT allocations, regardless of company specifics. And those institutional filings in November could reveal whether bigger players are building positions, signaling some conviction, or if they're just avoiding it. But the Q3 earnings, that's the moment of truth for their execution, I think.
Beyond the scheduled events, there's always the market chatter, right? The whispers, the what-ifs that swirl around a company like this. Rumors suggest potential government smart city contracts in Asia may be building on that Manila success. There's also speculation about a major U.S. healthcare partnership for AI video analytics.
That would be huge.
Wouldn't it? And even hints at licensing Iveda Solutions' AI analytics engine to other security firms, expanding those recurring revenues. And of course, market chatter always includes things like strategic corporate actions, reverse stock split, merger activity, things to shore up the capital structure.
It's really vital for listeners to distinguish these from confirmed catalysts, though. While speculative developments like these could certainly provide significant valuation upside, I mean, imagine a major U.S. healthcare partnership. They are, by their very nature, highly uncertain. They represent potential, yeah, but they aren't guarantees. For a company of Iveda Solutions' size and, frankly, financial position, any concrete news on these fronts would be a game changer. But until then, they remain high-risk, high-reward possibilities. It's like playing poker with a wild card. It could be a winner, but don't bet the farm on it.
Shifting gears then, let's look at the technical picture. In late August 2025, the price was hovering around $1.62. We see key support around $2.03. Think of that as a historical floor where buyers have stepped in before.
Okay.
And notable resistance at $2.11 and $2.23. Those have acted like ceilings, pushing the price back down. The 52-week range of $1.27 and $8.05. Well, that really tells you something about its extreme volatility and the recent steep decline. What do these technical indicators really signal for a potential investor?
They paint a challenging technical landscape, to say the least. Those widely watched indicators, the 50-day and 200-day simple moving averages, they help us smooth out price fluctuations, identify trends. They're at $1.96 and $2.52 respectively. Both are significantly above the current price, which strongly signals a bearish trend.
Ah, good.
No. And the MACD, our momentum indicator, is also firmly in negative territory, confirming that downward pressure. While the 14-day Relative Strength Index, the RSI, which measures speed and change of price movements, while it's neutral at 51.95, the overall picture, coupled with extremely high volatility, daily moves averaging 7.47% just last week and low liquidity, it means this stock is highly susceptible to rapid swings. It's been in a steep decline and is struggling, really struggling, to break above any significant resistance.
Okay. On the analyst front, there's very limited coverage. The only available analyst report we've seen is from Maxim Group way back in April 2023. They assigned a strong buy with an incredibly optimistic price target of $24.
Wow, $24 from 2023.
Yeah. More recently, a third-party analyst consensus in August 2025 still listed it as a strong buy, but this largely reflects just that single, rather outdated analyst report.
So it's basically an echo.
Pretty much. Meanwhile, social sentiment is categorized as fear. Score of 39 out of 100 on the Fear and Greed Index. What do we make of such a disconnect? An old $24 target versus current fear.
What's fascinating there is just how outdated and, frankly, effectively non-existent the real analyst coverage is. That strong buy from April 2023. Even with that audacious price target, you got to take that with a very large grain of salt, given the company's performance since then.
For sure.
The current strong buy consensus is, like you said, just a phantom limb of this single older report. It's certainly not broad institutional support or recent scrutiny. The fear sentiment among individual investors, on the other hand, that aligns much more closely with the current bearish technicals and the ongoing losses. It tells us individual investors are far more cautious.
Makes sense.
And the absence of any recent insider activity data. That suggests a lack of clear buying or selling trends from those closest to the company, which often gives us a peek into leadership's confidence or lack thereof.
So, bringing all this together, what does this actually mean for you, the listener, and your potential investment? The risks here seem incredibly clear. Persistent losses, operational cash burn that constantly demands more capital,
The burn rate.
and the very real potential for dilution. The likely need to raise more funds, right? That revenue decline in 2024 is a stark reminder, and those projected 300% plus growth numbers for 2025. They're not just ambitious, they require a level of flawless execution that's just, it's rarely seen.
Very rare.
Plus, with low liquidity and high volatility, shareholders are exposed to rapid price swings and potentially poor exit opportunities if things go sideways. Is there any way to mitigate these risks for an investor?
That's the challenge, isn't it? And beyond the stock-specific risks, we also have to connect this to the broader picture, market and sector vulnerabilities.
Right.
The tech and AI sectors themselves face evolving regulatory landscapes, intense competitive pressure from much larger, well-funded multinational firms, and let's not forget macroeconomic risks. Interest rate policies, economic cycles, they can significantly impact capital expenditure for IoT and AI projects, which is Iveda Solutions' core market, for mitigation. It truly comes down to understanding this isn't an invest and forget play. Not at all. For a company with this profile, constant monitoring is key. Their cash burn, new contract wins, progress towards profitability. It's paramount. But even then, many of these broader risks are simply beyond an individual investor's control.
All right. Bringing it all together then, after sifting through all the sources and data, Our analysis gives Iveda Solutions an overall rating of 3 out of 10.
Yeah, a 3. And why such a low rating? Well, Iveda Solutions is fundamentally a small-cap speculative play in the AI IoT space. It's characterized by recurring losses, that recent decline in revenue, very low liquidity, was highly optimistic 2025 revenue projections. They'd require truly flawless execution, and frankly, their realization remains highly uncertain. The analyst coverage is extremely limited, largely historical. It's not indicative of broad institutional support or current informed opinion. Technical signals, overwhelmingly negative. Market sentiment, bearish. The price is near historical support, but well below significant resistance levels. It's simply not presenting a compelling risk-reward profile for most investors right now.
So what does this all mean for your investment horizon? It seems clear this company is really better suited for very short-term trading. If you're comfortable with extremely high volatility and speculative swings.
A big if.
A very big if. For a long-term investment, the consensus seems clear. It's not recommended until profitability and consistent execution are clearly demonstrably proven. That was a comprehensive look into Iveda Solutions. It's apparent there's innovative potential in their technology, but also some significant hurdles they need to clear before becoming what you might call a stable investment.
And that leads to a critical question for you, the listener, to really ponder. How much risk are you truly comfortable with when weighing a company's innovative potential against its current, very challenging financial reality?
Exactly, something to think about. Thank you for joining us for this analysis of Iveda Solutions. We hope this discussion has given you a much clearer picture. We'll be back soon with another detailed look into a company you asked us to break down.